So the banking crisis isn't over, and we said many times before, it's the regionals that are in trouble. Guys, we are moving towards an era of bigger banks. Your big boys, the JP Morgans, your Wells Fargos, are going to get bigger, while the smaller community banks are in crisis mode. In a shocking move, the ratings agency Moody's just downgraded a collection of American banks. We are talking about 10 regional banks as well as 6 bigger ones that include New York Mellon and State Street. They are all on downgrade watch. Now, when Moody's downgrades your credit rating, this is bad news, especially if you need to raise money to stay solvent. If you were issuing 6% on your corporate bonds, now you need to offer 7% to attract investors. And as a bank, you are always competing with the US Treasury. Janet Yellen always has the Federal Reserve as a contingency plan. She can always ring out power to print money, but the regional banks can't. Now, the reasons Moody gives for the downgrade are supremely important, and we mustn't just glance over them because it goes in the face of what Biden is calling the resilient economy. And here's what Moody said: Q2 results of the banks showed growing profitability pressures that will reduce their ability to generate internal capital. And this means the banks are making less money. They're also generating less cash. And we know that liquidity is the name of the game today. There's always a bank run around the corner. And if you don't have enough cash, you'll be the next signature of First Republic collapse. But it gets worse. A US recession is on the horizon for early 2024, and asset quality looks set to decline from solid but unsustainable levels, with particular risk in the commercial real estate CRE portfolio. And let me translate this. Moody is saying that a US recession is going to crash the assets of the regional banks, and this collapse could be triggered by commercial real estate. We must understand the chain effect here. If assets like loans start to crash, the banks will take a big loss on literally everything. The loans could either outright default and the banks are left with squat, or they have to renegotiate the interest payments with lenders, which dries up their income stream. Suddenly, they get less cash flow coming in, which is horrific in today's environment where cash is king. And if the regionals get desperate enough to sell all their assets, depositors, they will smell blood in the water like sharks and they'll rug pull the small banks. You'll have more bank failures and more bank mergers. I want to repeat that the smaller regionals are not the big banks. This is a regional banking crisis. There will be winners and losers from this carnage, and my money is on the big boys growing even bigger. Wall Street will always win. It's just a matter of who. And as we speak, there are around 4,800 banks in the United States. During the '08 crisis, 25 banks collapsed, including Washington Mutual, which was the biggest failure in US history. Now, what's interesting is the FDIC themselves tracking all the bank failures so far. In 2023, we had 4 failures that totaled around $550 billion. And this includes SVB, Signature Bank, and First Republic. But pay attention to this. All the banks that failed were eventually acquired by bigger competitors. SVB was acquired by First Citizens Bank. And let's not forget the takeover of First Republic by JP Morgan. So if you're invested in the regionals, things could get very rocky. And if you're holding stocks in the big banks, you could strike the lottery if they gobble up a regional doing a fire sale. And the main reason why Moody's downgraded the regionals is because of declining profits. Thanks to rising interest rates and customers growing a brain, the smaller banks are in big trouble. And what we are seeing is shrinking profits for the banks. As the Fed funds rate rises, it makes sense for the loan yields to rise as well. But look carefully at how narrow the gap is today. Banks don't have to loan money to customers anymore. They can just park the cash with the Federal Reserve. Why risk your money for 0.6% more yield? Doesn't make sense. And back in 2019, and especially in 2020, the gap between the Fed funds and the loan yield was enormous. Plus, the cost of deposits, which is what the banks pay you, was a complete joke. I'm sure you can remember a few years ago, you were getting 0 to 50 basis points maximum on your deposits, while the banks, they were lending the money out at almost 4%, and that's how they were paying multi-million-dollar bonuses to everyone. This was your Wolf of Wall Street era. The banks were making it rain and everyone were driving Ferraris and eating at Nobu Sushi. But things are changing, especially for the regionals. Now the median cost of deposits is starting to rise from 0% to 1.5%. And this number is much higher for the regionals. They are now forced to pay higher interest rates to retain deposits, and it's only going to head up. The average depositor, they are waking up. They are pulling their cash out of the regionals and stashing it in either the big boys or money market funds. So the smaller banks have to jack up interest rates. And according to Moody's, the banks had to replace it with funding that's more expensive. It's a profitability concern as deposits continue to leave the system. And this is where we need to separate out the difference between the big banks and the smaller fish. What is the difference between, say, JP Morgan and PacWest? And I'll boil it down. Basically, the big banks are too big to fail. And everyone knows if a giant starts to fail, the US government will mobilize the Federal Reserve and the FDIC to save them. There will be a massive bailout. And because of this implicit guarantee, everyone at the back of their heads, they realize that the big banks are actually the safest places to stash your money. So the big boys, they don't need to pay you higher interest rates. Look at the amount of interest Bank of America pays for their savings account. It's well under 1%, when the Fed funds are already at 5.5%. But people are still stashing money there because they are too big to fail. There's a hidden government guarantee of a bailout, but that's only part one of the horror show. Deposits are also leaving the regionals because the US government itself is giving higher yields thanks to the Federal Reserve hiking rates and our best friend Janet Yellen flooding the market with treasuries. Yields on the short end, they are rising. And pulling a story from Bloomberg, money market assets climbed to fresh record with rates above 5%. And it makes total sense. If you're chasing yield, what's the point of putting it in regionals when the US government itself can return you a risk-free rate of over 5%? We need to realize that when money chases yield, it flows towards the path of least resistance. When you buy treasury bonds, you know in a worst case scenario, the Fed will likely step in as a backstop. They will bail you out with money printing. And that's why we have over $5.5 trillion inside money market funds. It's not rocket science why money is hiding there. Money markets pass on the benefits of rate hikes faster to customers because their management costs are just so low. It's basically like 10 guys in a room versus a gigantic bank with 1,000 branches across the country. And people have more options today with their money, and that's the main reason why the regionals are getting squeezed and the outlook is getting from bad to worse. The Federal Reserve has come out saying that multiple rate hikes are still needed to cool the US economy. According to Governor Bowman of the Fed, inflation is still higher than the 2% goal, so additional increases could be coming. And just imagine what happens if interest rates really hit 6% or higher. The amount of deposits that will leave the smaller banks will be legendary. But let's also address the elephant in the room, which is the CRE, time bombs. Now, all these commercial real estate loans are going to put additional pressure on the smaller banks. Nearly $1 trillion worth of CRE loans are coming due very soon, and this tsunami could destabilize the regionals even faster. And I want us to pay attention to two numbers. The first is the yields on the commercial mortgage bonds, which are nearing 11%. So if you think your 7% mortgage loan is painful, landlords are facing an absolute nightmare. And the next number is equally disturbing. According to Wells Fargo, 2.5 trillion of real estate loans will come due through 2027. And this is a time bomb just waiting to explode. By as early as next year, around $1 trillion of CRE loans will come due. And this means they have to be refinanced at higher interest rates. So if you're a landlord, your cost of financing could essentially double while your rents are dropping. The demand just isn't there because everyone is working from home and the economy is slowly starting to slow. And there are a ton of reports from McKinsey and Morgan Stanley that predict doom and gloom. Office building prices are going to drop by at least 25%, and some estimates peg it at 40%. And this is going to smash the regional banks. It could burn a big hole in their balance sheet. Take a look at today's CRE loans and focus on the regional banks. Their interest rates are up to double digits, which is going to spook out landlords. There'll be more defaults across the board. Landlords are going to hand back their keys, right? Which is going to hammer banking profits. And understand what a default means, guys. It means regionals will lose a valuable income stream. The landlords stops paying their monthly payments, and that's a big problem. Then the banks will have to take all those properties, the hotels, the office buildings, and auction them off at a loss. they'll be selling into a falling market. And what does this do? It burns a further hole in their balance sheet. And if depositors get spooked out enough, they will pull their money out and run to JP Morgan or the money market funds. And this ironically will force the regionals to jack up their deposit rates further while their income streams are dropping. Their expenses will go up while revenue goes down, and that could lead to insolvency. So put yourselves in the shoes of the regional banks. Would you want to further expose yourself to CRE loans? You likely won't, right? You'll run to the Federal Reserve's reverse repo market. You'll just park your cash with the Fed for 5.3% yield with virtually zero default risk. And this puts a further squeeze on credit and raises interest rates on loans even more. It's a vicious cycle that won't end well unless the Federal Reserve starts to slash rates soon. And once more, I'm not predicting the end of Wall Street. What I'm saying is the likelihood of the regionals consolidating and getting eaten up is very high. I'm saying the smaller regionals will suffer while the big banks will enjoy the spoils of the collapse. Now, just take a look at the stock of JP Morgan. After the acquisition of First Republic, it went up because JPM has the balance sheet to weather the crisis. They have the liquidity to ride out the storm, and over time, all the assets they bought in fire sale will turn green and spit out money. However, the regional banks are struggling. As a whole, the smaller banks are down 11% year to date. So there are winners and there are losers in this banking crisis. Wall Street always wins, but the question is who will win? Check this out. Private equity group KKR is scooping up auto loans from regional banks. They are shedding their assets because they need liquidity. Then you have property loans also being dumped. But because they are so illiquid, the only way you can get rid of them is to sell at a big discount. The big banks aren't in a rush to sell, but the regionals might have to take a big haircut in an emergency. So if you have the ability to really identify the companies that can eat up these cheap assets, you could win big in this banking crisis. Money doesn't get destroyed, guys. It just flows from one area to another. So let me know what you think in the comments below. Will more regional banks crash and burn? And who will be the big winners? Let me know in the comments below. Stay safe. Be sure to smash the like button and subscribe as we navigate through these crazy times.